In all the years since I began investing, 2020 has been the most strange year. You have to feel terrible for those new investors who are just getting started in the stock market. These shallow waters can be difficult to navigate without guidance. That's why I made this video. I want to offer guidance so that you can navigate through these challenging times without being burned and losing your investment capital. Welcome to Finance Dojo! We aim to be the best personal finance educational channel you'll ever need. Click that subscribe button and the notification bell right now so you won't miss out. Now, one video isn't going to turn you become an investment genius, but it will put you on the right track to investing wisely during times of volatility. Here are 5 methods that I use, Buffett uses, and the top investors use to outperform other investors and win long-term. Tip number 1. Control your emotions. Those who can handle emotions will be one of the things that separate average investors from great investors during these times. According to Jordan Peterson, we are the trustworthy ones during a relative's funeral. We must expand on that advice and apply it to investing, particularly during and after a market meltdown. This is the attitude that 90% of investors adopt when their stocks rise in value. They go out and tell their buddies at the bar how much money they've earned. They check their stocks weekly, if not daily, and their emotions are all caught up in the stock market's ups and downs. The small number of investors who perform the best, on the other hand, are those who do exact opposite of those folks. When equities fall in value, winning investors rejoice because it implies their stock has become less expensive, allowing them to purchase more at a lower cost. They know that the lower the price at which they acquire equities, the bigger their long-term gains will be. Buffett says, "You're dealing with a lot of silly people in the marketplace. It's like a great big casino, and everyone else is boozing. Buy low, sell high." Regrettably, the majority of investors do the exact opposite. Tip number 2. Select an area in which you excel. If you want to have an advantage over other investors and earn those high-level profits, you should invest in sectors that you are familiar with. So what I guess is that you take a step back and analyze the areas that you are familiar with. It may be gaming, artificial intelligence, social media, or any other form of technological enterprise if you're a young man. If you're older, you could have an edge in more mature industries such as hospitality, travel, wine, and cuisine, since you know something about such things. Buffett only invests in more established company models that he is familiar with, such as See's Candy, which distributes sweets. This business model has been around for a long time, and Buffett understands it. Insurance, for example, is something Buffett spent a lot of time learning about. Buffett understands the game so well that he can choose the best firms to invest in, and you should be doing the same. As I previously stated, if you're young and enjoy gaming, you probably have a better notion than the majority of people about which companies will dominate in the future and which sectors will flourish. That's why one of Peter Lynch's most famous lines is "Know what you own and why you own it," which is simple but brilliant. In any industry, the majority of investors desire to make money. They want to tell their friends about all of their companies at the bar, but they hardly stick to industries that they are familiar with. And they rarely comprehend exactly what they own and why they own it, which is why you should not be like most investors. Tip number 3. Learn the game first. If I approach a stranger who had never played poker before and asked if they wanted to join me and my buddies for a game of poker, would each of them put in $500? If the individual answered yes to the game because he'd never played before and was going to lose money, he'd be a fool. If we apply it to the stock market, we'd be surprised at how many new investors are unaware of the fundamentals of investing. They are crushed for 1, 2, or 3 years, and this is unavoidable. If you're new to stock market investing, especially in these difficult times of 2020, there are a few things you should know. One of the most crucial indicators to understand is the PE ratio, which compares how much you spend for a company to how much it earns. Return on equity is a useful metric for determining a company's profitability efficiency. Are you familiar with stock market orders? What exactly is a limit order? Is this a market order? A limit stop order? Before you invest, you should be aware of the following. What is your understanding of a range of different fundamental strategies that you can use? Warren Buffett's value investing method involves purchasing assets at a discount to their intrinsic value. Do you have any knowledge of the dividend aristocrat strategy? A set of equities into which you can dollar cost average and, according to history, outperform the market over time. Before you become an investor, you must understand these fundamental strategies and the simple approaches that can help you understand the PE ratios. Tip number 4. Ignore the minor details. This is one of the easiest rules to invest in, but it's also one of the most difficult to follow. Most investors are obsessed with the stock market's day-to-day, week-to-week news. The point is, every time you get a bit of news, you get a dopamine rush. As a result, 90% of investors are fixated on the short-term performance of the stock markets. Now, I don't have an issue with this, but it harms your investment strategy and, as a result, your investment returns. One of the drawbacks of focusing on the very short term is that you miss long-term patterns. When looking at the stock market for a week or even a month, these are usually little dots of a larger term patterns. As an investor, if you are fixated on the short term, you will make judgments based on it, which will result in lower investment returns in the long run. This is why Buffett advises, only buy something that you'd perfectly happy to hold if the market shut down for 10 years. Don't be concerned by the daily news or the little details. Tip number 5. Understand market cycles. The next concept you'll want to grasp is market cycles, particularly in 2020, when we're nearing the end of the cycle. Now, what I'm talking about is figuring out which stocks do well throughout specific periods. Transportation, technology, and capital goods stocks often do well in the early to middle phases of the market cycle. Why? Because things are starting to expand and the economy is heating up. Transportation is becoming more important. During these periods, technology stocks are frequently on sale for a bargain, and they have the potential to skyrocket in value. If you bought Netflix, Tesla, or Amazon 10 years ago, it was just as the market was beginning to heat up. However, as the cycle progresses, more conservative stocks, such as consumer non-cyclical and healthcare, begin to perform better. Why is that? Because people still need to eat, toothpaste, soap, clean water, and so on, so consumer on non-cyclical stocks are safer to own. They also require medical attention. Therefore, healthcare stocks perform well in the later phases. This is what I'm talking about as a newcomer entering the stock market. You must understand these concepts and know which stocks perform well. As the saying goes, you can buy the strongest stock in the world, but if it's in a weak sector, you'll lose. That's one of the reasons why I like to follow Ray Dalio. He provides historical evidence and compares it to current market conditions to help us understand where we are in the market cycle, so I can structure my portfolio appropriately for market conditions in 2020. So if you're a beginner investor, I'm sure you wish you had started 10 years ago when the economy and market were in their infancy. But at the end of the day, all you can focus on are the market conditions that we're in right now. And these little tips that I've shared with you will help you navigate the waters for these unique market conditions in 2020 and beyond. I wish you all the best of success and hope you can achieve those great investment returns. As always, this video is for educational purposes only and not financial advice. You should always do your own research and speak to a financial advisor before making any investment decisions. Thank you for watching and see you in the next one.